If you've worked from home at any point this year, this video could literally save you money. Whether you're full-time remote, hybrid, or just clocking a few hours from your home office. Understanding the work from home rules could mean the difference between a small tax refund and a big one. I'm Stephen Blake, Chartered Tax Advisor and Director of Bristax. I've been doing tax since 2001, and I can tell you, the amount of money I see people leave on the table every year is surprising. We're talking hundreds or even thousands of dollars that could legally belong to you. So let's break down what you can claim, can't claim, and how to make sure you stay on the good side of the ATO in 2026. Let's get into it. If you worked from home at any point this year, you've got two main methods to calculate your deduction, the fixed rate method or the actual cost method. With the fixed rate method, you can claim a fixed rate for every hour you work from home. That fixed rate covers your internet, phone, electricity, and gas for heating and cooling, plus stationery and computer consumables like printer ink. Currently, that rate is 70 cents. It usually increases slightly each financial year. Something to keep in mind with the fixed rate method is that once you use it, you can't claim those expenses separately. So if you've got a big phone bill or high electricity costs, they're already included in the fixed rate. You can still claim depreciation on work equipment separately though. Things like your desk, office chair, laptop, monitor, as long as they're used for work purposes. To use the fixed rate method, you need to keep a record of every hour you worked from home throughout the entire year. A timesheet, diary, or roster is suitable for this purpose. The actual cost method is where you calculate the actual cost of each expense and claim the work-related portion. This method covers the same types of expenses like electricity, gas, phone, internet, stationery, equipment depreciation, and you can even claim cleaning costs for a dedicated home office. But instead of a flat rate per hour, you work out the actual dollar amount you spend on each expense, then apportion it based on how much you use it for work. Let me show you how this works with electricity. Say you worked from home 800 hours this year. You use an air conditioner that consumes 2 kilowatts per hour, and your electricity costs, say, 30 cents per kilowatt hour. Your calculation is 2 kilowatts times 30 cents, which equals 60 cents per hour. You then multiply that by 800 hours, and your electricity deduction for cooling alone is 480. Now, add in your laptop, monitor, lighting, and other appliances, plus your internet and phone bills apportioned for work use, and you can see how quickly this adds up. However, the trade-off is that you need records for everything, and you need to calculate the work-related use percentage for each cost. Now, it's important to realize that you can choose whichever work from home method that gives you the higher deduction. So, let's say you worked from home 1,000 hours this year. The fixed rate for this last financial year would have given you, say, 700 plus any separate claims for equipment depreciation. But if you're running significant electricity bills, paying for internet and phone, and you've got a dedicated workspace, the actual cost method could push that deduction to 1,500 or more, depending on your specific expenses. The difference comes down to tracking. Fixed rate needs a record of your hours. Actual cost needs receipts and a calculation of the work-related percentage of each cost. So, it just depends on what works best for you. Now, there's also a third option that can add thousands more to your deduction, but it only applies if you meet specific criteria. It's called occupancy expenses, and it lets you claim a portion of your mortgage interest, rent, council and water rates, land taxes, and even home insurance. But you can only claim them if your home office meets strict criteria. For example, the room needs to be used exclusively for work, not just a desk in the corner of your bedroom. A dedicated space that functions as a place of business. This typically applies if you're self-employed or if your employer requires you to work from home and doesn't provide an alternative workspace. So, let's say your home office takes up 10% of your home's total floor area. Your annual occupancy expenses a mortgage interest of $40,000, council and water rates of $4,000, and home insurance of $2,000. That's $46,000 total. You can claim 10% of that, which equals a $4,600 tax deduction. For someone earning $100,000 a year with a marginal rate of 32% including Medicare levy, that's about $1,472 in extra tax refund. For someone earning $200,000 a year with a marginal tax rate of 47% including Medicare levy, that's about $2,162 in extra tax refund. But here's what you need to know before you claim this. If you claim mortgage interest as an occupancy expense, you lose part of your main residence capital gains tax exemption when you sell your home. Let me explain. Normally, when you sell your home, you don't pay any capital gains tax on the profit because of the main residence exemption. But this exemption only applies if your home hasn't been used to produce income. The moment you claim occupancy expenses like mortgage interest, you're telling the ATO that you've used part of your home to produce income. And that means the portion of your home used for business loses the CGT exemption for the period you claimed those expenses. So, if your home office takes up 10% of your house's floor area and you claim occupancy expenses for 5 years, when you sell your home, 10% of your capital gain for those 5 years becomes taxable. Let's put some numbers on this. Let's say you bought your house for $600,000 and sold it 10 years later for $1 million. That's a $400,000 capital gain. If you didn't claim any occupancy expenses, you pay 0 CGT thanks to the full main residence exemption. But if you claimed occupancy expenses on 10% of your home for, say, 5 years, you lose the exemption on that portion. 10% of 400,000 equals 40,000. But since you only claimed it for 5 years out of 10, half of that 40,000, which is 20,000, becomes taxable. With the 50% CGT discount, which would apply as you held the property for more than 12 months, you paid tax on 10,000. At a 32% marginal rate, that's 3,200 in CGT. So the question becomes, are the annual tax deductions you're getting now worth a potential CGT bill later? In the example above, if you save, let's say, $2,100 per year in tax over 5 years, that's $10,500 total, minus the $3,200 CGT bill when you sell, you're still $7,300 ahead. But if your home is appreciating rapidly, or if you're only claiming small occupancy deductions, the CGT hit might outweigh the annual tax savings. This is where planning matters. For some people, the trade-off is worth it. For others, it's not. Before we wrap up, let's go over 4 common mistakes to avoid. Number 1, guessing your work from home hours. You need proper records. Number 2, double claiming. Don't claim phone, internet, or power separately if you're using the cents per hour method. 3, forgetting to apportion shared use if you share internet with your family. And 4, claiming occupancy expenses when your work from home is optional and not mandatory. And a couple of tips. Use the method that benefits you most. If you've got high phone, internet, and power costs, the actual cost method will likely be better. Otherwise, stick with the fixed rate method. Keep track of your work from home costs all year. Don't wait until July. Start recording your hours and bills now. If you're sitting there thinking, this sounds great, but I need help figuring out which of these strategies apply to my specific situation, or I want to make sure I'm not missing any other opportunities, well, that's exactly what we help people with. At Bristax, we work with high income earners to legally reduce tax and maximize tax refunds. You can contact us through the link in the description below. Thanks for watching. I'll see you in the next one.